Hello and welcome to the latest trades and tutorials video. This is Jeff Bish, president of MarketGauge.com. And in today's market, we had a little bit of a meltdown. I think it was generated by the machines in the NASDAQ market, driven by technology and chip stocks. And it just so happens that last night, Thursday, I did a free training on how to avoid getting caught in situations like this. And not only not getting caught in situations like this, but using a really simple tactic to give you a really strong indication of which way the overall market is likely to go next on an intraday basis and even in days moving ahead. So before we get into that, I just want to make sure if you're just finding this video on YouTube, please like and subscribe. If you're finding us on Facebook, please like us, and please also note that you can get this video in HD by changing the settings in the lower left-hand corner. All right, so the tactic that I'm going to show you right now is simply based on a 30-minute opening range. It was an important point, not the entire point, but the important point of the free training that I did last night that should be available for the rest of this weekend. If you haven't seen it, I'll put a link to the replay in the bottom or in the text of this particular presentation. If you're seeing this weeks in ahead and the replay is no longer available, I'm sorry about that. So here's the important point. We're looking at all four major market indexes in their ETF form in a 5-minute chart, which 5-minute chart isn't really all that important. The important thing is we can see the SPYs in the upper left-hand corner, the Qs in the upper right-hand corner, the diamonds in the lower left, and the IWMs in the lower right. And essentially during the day, you want to see all these things doing the same thing. And if they're not doing the same thing, then it's a big heads up. Now, when I say doing the same thing, the benchmark there, or a powerful benchmark, is to look at the first 30 minutes of the day, define that as your quote-unquote opening range, and then how are all these indexes trading relative to that opening range. It's really a simple concept that is incredibly powerful, and today was a perfect example of it. So one of the objectives of looking at the market this way, as I said earlier, is if you look at the Qs, I'm sorry it's so scrunched, but that's because we had a little meltdown here today. The green line here is the high of the first 30 minutes, the red line is the low of the first 30 minutes, and the basic premise, the basic rule number one of opening range trading and protecting your assets is that if the market is below that opening range, the bears are in control. Now, it's not always simply that straightforward, but it does start with something as simple as that. So if you were to take the position that if the market is significantly under its first 30-minute opening range, you're going to at least be cautious. You should never find yourself getting absolutely hammered the way this market got hammered today. But today there was a lot more to it. Because if you look at all four and figure and look at them from the context of are they all doing the same thing, should I trust this trend, today was a really important lesson because the markets got off to a really good start, especially if you were looking at the SPYs. They opened higher. You can see kind of yesterday's range here. They opened higher and then they went above their 30-minute opening range and held above it. And so the bulls looked like they were in control here. If we were to look at the Dow more or less did the same thing. They held above their opening range, looked like they were in pretty good shape. And IWM was extremely convincing. They didn't even pause. They just kept going straight up. So if you were only looking at the SPYs or only looking at the Dow, things looked pretty good. If you were only looking at IWM, things looked really great. But if you were looking at the whole picture, and you don't have to be sitting there looking at this minute by minute, hopefully this viewpoint will illustrate that. What would have stood out if you watched the opening range for any length of time, or if you look at our free training, what would have immediately stood out is that the Qs never really got over their opening range. I know they did a little bit, but the boldness of these lines are hiding it. But the fact is the lines on all these charts are just as bold, and you can see that the SPY's well above it. Qs did not do anything significant above their opening range. So that's a little bit of a warning. But where it becomes a real problem is where you've got the leading index breaking down below its 30-minute opening range and then continuing with a second breakdown. So if we just look at what's going on at 12 o'clock on all these time frames, again, the IWM looked like it was all rosy. Now, I was actually focused on the IWM because as per the training last night, I bought the IWM breakout today. That's the one I expected to be the strongest. And so I'm long the IWM. But at 12 o'clock, when everything looks great in IWM land, I'm looking at the Qs and seeing that they're falling apart. And to make matters worse and more obvious, the SPYs are now falling back down below the high of their opening range. And they weren't able to continue higher in the same way the IWMs were, right? Same thing becomes painfully clear with the Dow pretty soon after. And then the whole story continues to unfold. And the unfolding of the story was that it went from things 3 out of the 4 looking like things were good to pretty soon 3 out of the 4 looking like things were bad. And with the only one looking like it was trying to hold up was IWM. So, in my case, if I'm long IWM and just got long IWM, I don't want to take a loss after such a big run, so I'm going to look to exit the trade on a no loss. And that's being generous because clearly by 1 o'clock, 1:30, where we had the SPYs looking like they're breaking down, the Dow was barely holding on, and NASDAQ was basically in a free fall. This is not a day that we should expect that the overall market was going to have a bullish run. All right, so this is one way that you can take this simple concept and, one, protect yourself, two, really understand which days are the days that are going to be powerful breakouts. Now, in the context of this video, I'm not going to go into other individual positions, but from a swing trade perspective, when I see that the market looks like it's rolling over, I then just go to my positions that I don't want to hold through any significant drawdown, look at where their opening range is, make sure I've got stops in place so I don't get caught in a meltdown like we saw in the QQQs or the meltdown and which precipitated the QQQ meltdown. If you look at what happened to Amazon, it was a complete bloodbath. All right, it was like a mini crash, and then stuff like that can be avoided if you just take some time to figure out how to use the opening range. You don't need to sit here and be a day trader, take advantage of it. Like I said, when you see these patterns developing, all you have to do is make sure that you've got your stops under the right support and resistance levels and use the opening range to help define those. So if you haven't seen the training, I really do encourage you to get it before we take it down. And I would expect that, given this price action, we're going to see a lot more days like this that you can take advantage of this volatility or you can protect yourself against the volatility. It doesn't have to be that difficult. So I hope that helps, and I'll see you in the next video.